This past year might have made you think that you'll never get into real estate investing. Demand and pricing are still high, and no one knows where rates are about to go. But what I'm going to show you is why investing in real estate in any market can bring you and your family long and lasting wealth. And my career is a testimonial to that. I got started in 2005. I rode a really good wave, and then the market collapsed in 2008. And the best thing that I ever did was buy when everyone said it was too hard to do, or they did not think it was possible. But because we made that decision and we put together the right strategy, we were able to achieve wealth today. So what I'm here to tell you, it is not the market conditions, it's how you adapt and how you implement your strategy in today's market. So what's the benefits of owning rental property, especially in a market like today? High pricing, high interest rates. How is there any kind of benefit? Well, the four main reasons why rental properties are amazing and can get you to financial freedom a lot quicker is the first way is you get to dictate what your cash flow is. You can go out and identify properties that you're interested in purchasing and go to different markets that are going to give you different types of returns. Different markets will pay you different returns with your cash flow. You get to buy a property, you invest the money, and you get a monthly check. And after this high interest rate cycle, you're going to be very happy you did because rates go up and they go down. We saw rates get at all-time highs and they've been slowly moving down. In 2 years, your cash flow could dramatically increase if rates continue these trends. Remember, rates are temporary. Real estate allows you to pay your loan down. So as you buy this property, you fill it with a tenant, they're paying you monthly cash flow. That's the income you're making. In addition to, they're paying off your debt for 30 years. You don't need a 9-to-5 to pay for this house. You have a tenant that is going to pay it down. And over the life of your loan, it's going to continue to be paid down by other people's money. At the end of the term of your loan, you're going to have a lot of equity and you're going to have even more cash flow because you're not going to have that monthly payment. The third, appreciation. We all hear that our grandparents got to buy homes for a couple $1,000 way back in the 20s and 30s, right? And we all wish we could have bought those properties. Well, guess what? Today, it's a couple $1,000 still. You don't want to be thinking back and going, I could have just bought that property for $425,000 30, 40 years ago. Over the history of housing, the prices go up. Appreciation is a great way to grow steadily. Over the last 30 years, the average appreciation is roughly around 4.5% to 5% on average. Not the normal that we saw the last 3 years, but 5%. So if you invest in a real estate property for $300,000 and it appreciated 5% every year for 10 years, that $300,000 asset is going to grow to over $488,000 over a 10-year period. In addition to, you're getting cash flow and paying down your principal, so you're hitting it on all three sides. Appreciation gives you that steady growth that compounds on themselves every year. And lastly, tax benefits. Not only are you growing your investment with cash flow and appreciation, you get a tax incentive by owning real estate. Every year, you can depreciate down your property. You can do a cost segregation and do bonus depreciation and get a bigger incentive, or you can go with a standard depreciation. But every time you do this, it takes down your tax balance every year, so you pay less taxes and you have more money to go invest and buy another property. A great first step to you getting the first rental property and reaping all the benefits we just talked about is about joining the BiggerPockets Bootcamp. From rookie investors to aspiring Airbnb hosts and small multifamily landlords, there's a community for everyone. Choose your bootcamp at biggerpockets.com/boot. So there's 8 steps to getting into your first real estate property. The first one is determine the market. What are you trying to achieve in your investing goals? Are you trying to get high cash flow? Are you trying to get high appreciation? Where do you want to do that? And what markets do you want to be in? Every state has different real estate. They have different pros. They have different cons. Some markets do really well about being low down and paying you high cash flow. Some markets, you got to come up with a lot more money down, but you make much bigger appreciation gains. And so it depends on what you're trying to do as an investor. So you want to determine that market. You determine the market by establishing your buy box. If I want to go buy a rental property and I want to make a 10 to 12% return, I might want to get out of an expensive West Coast market and go more Central America so I can get higher cash flow, cheaper properties, and build it that way. So establish your buy box and determine your market. The second, get pre-approved. You have to be able to get financed to grow in real estate. Debt is a huge deal as you try to grow your portfolio, but it's also a great way to get into your first deal. There's so many different programs out there that you could be exposed to just by getting pre-qualified. What do you qualify for? Do you not own any property? Can you do a first-time home buyer house hack? Or do you already own a property and you need to go buy a rental property? The first thing you need to do is make sure that you can pay for it. The second thing you need to do is get your interest rate quote from your lender so you know what your monthly payment's going to be. You don't want to buy a rental property without being able to know that your rent can service the debt. So you want to get those quotes, lock down your interest rate, and then go start shopping, because if you don't know your rate, you don't know how to properly calculate your cash flow. Third, you need to learn how to analyze deals. Underwriting is the backbone of real estate investing. Underwriting is going to help mitigate your risk and tell you whether this investment's safe, but it's also going to help you exponent your growth. By buying the right properties and analyzing them correctly, you can make a lot bigger gains. So you want to become a master of underwriting your properties. For underwriting, you want to master these core mechanics. The first, establish the as-is value of the property. What is the property worth today and what are you paying? Are you getting a discount? Are you buying a good deal? The second, what is the potential of the property? Where could that property grow in value when you renovate it? The third, how much money do you need to put into this property to increase the value so you can gain the equity or gain the rent growth to where you can cover your debt? Practice makes perfect when it comes to underwriting. The more reps you do and the more practice you have on properties, the faster you're going to get at it, the better you're going to get at it. So refine your skills. I can underwrite a rental property in as little as 5 to 10 minutes fairly quickly. I did this because I had the reps. I have 18 years. I've underwritten thousands and thousands of properties. We've purchased over 4,000 properties with us and our clients. And so it's all about that repetition. The more you practice, the more refined you'll be. The more refined you'll be, the faster you'll get to financial freedom. After you've been pre-approved and you've learned to analyze some properties, now the fun part starts. You get to shop for properties. The best way to find a potential rental property as a new investor is to find the right broker. Not every real estate broker is made the same. Some specialize in luxury, some specialize in first-time home buyers, and some specialize in investment. These investment brokers are going to be able to help assist you in the underwriting of your property. For example, at our brokerage, Dainard Real Estate, we don't just send out listings to clients that want to buy investment properties. We send them a listing, we send them a purchase price they should be buying at, what it will rent for, and what the future value is. So by having the right broker, it's going to help you underwrite through more properties. You're going to be looking at the right properties because you're going to scrub them all down, and it will help get you going on financial freedom a lot quicker. So once you have deals coming your way, and that's the fun part, right? You're shopping for a deal. Who doesn't want to buy a deal? Then it comes down to the analysis of the property. We've talked about how to prep to underwrite your property, pulling the as-is value, the fixed-up value, your renovation budget, what will it rent for, which is going to tell you your gross income. Now it's about putting a pro forma on it. When analyzing, you want to take your total cash invested on the property. You're going to look at what's your total annual cash flow. That's your monthly gross income minus all of your expenses, your mortgage, your property taxes, your insurance, your property manager. You're going to divide that annual income by the cash invested, and it's going to kick you out your annual return. When you build your buy box, you want to set what your expected return is for your holdings. Once you put it in a pro forma, it's going to tell you what your estimated cash flow is, and then you can say yes, no, or adjust your strike price and try to get a better deal. For help on your pro formas, make sure you go to BiggerPockets.com, become a pro member, and download their calculators. They have rental calcs, BRRRR calcs, everything you need to crunch those numbers. Once you've analyzed the deal, then it's the fun part. Put it on paper. Let's make that offer. Agent can help you prepare that offer. I advise highly, if you're a newer investor, work with a good investment broker. You want to know what your terms are. You want to know what your inspection timelines are. How long do you have to finance that deal, and what's going on with the earnest money, and where's your risk in it? What inspections do you need? Can you get out if your numbers start changing? use the right broker that will protect you through the transaction. And if you don't get the deal and you get rejected, that's okay. You guys, I get rejected every day. I definitely get rejected more than I'm welcomed. On average, you guys, at our office, we write 40 to 50 offers a week and we get 1 to 2. That is the law of averages. The more offers you write, the more refined you're going to be as an investor. If you keep missing and striking out, maybe you go back to your underwriting, you tweak it, you see what you can revise. And if your numbers are right, then by taking a swing, you're just closer to that next hit. Every time you get a no, you're just closer to that yes. So keep writing, stay disciplined. The more disciplined you are, the more transactions you'll do. And when you're happy with all the numbers, then you're good to close. So during your closing process, you want to make sure you're working with your lender, working with your broker, making sure they're hitting their timelines. If there's been any changes in your financing, if you're doing a construction loan, making sure that that's all set up right up front. Once you go to closing, you'll wire in your down payment. The lender's going to wire in the remaining funds, and escrow will handle the exchange of property for money, and then the property is yours. And once you purchase the property, now it's your time to figure out how hard you want to work. Do you want to be an investor that does self-manage, or do you want to hire a property manager? Now, for the investors that have the 9 to 5, you got a full-time job, or you have a packed schedule, bringing in a property manager is probably going to be the right call. These are people that are going to put your property up for rent. They're going to screen your tenants. They're going to qualify your tenants. They're going to move them in. They're going to ensure payments are made on time and deposits were made. So they're managing your investment for you, but it comes with a cost. Your typical property manager is going to be anywhere between 6 and 10%. The reason there's a range is it depends on how many units you have. The more units you have, the price goes down. You know, if you have a 4 unit, it might be 6 to 7% because they can manage 4 at one space. If you have a single family house way out in the middle of nowhere, then they might charge you that 8 to 10%. And so as you're going through and you're getting pre-qualified, you're running your performance, talk to these property managers so you can put it in your performa and know your costs. Now, if you're trying to be a little bit more thrifty like I was for the first 7-8 years of my investing career, you know, we were buying property, rates were high, rents were really low, the market wasn't great. There wasn't a lot of cash flow in these deals, but we were getting good opportunities. Now, to make them good opportunities, we decided to self-manage. That extra 8% a month made a big deal on my bottom line. My goal was to grow my portfolio, and I did not want property management to stop that from me. So for the first 8 years, as I grew up my cash flow and grew my portfolio, I self-managed. Now, I don't always recommend that either because dealing with tenants can be draining. I'm Mr. Nice Guy and would always give people a break, and sometimes that would get you. And so at the 8-year mark, that's when I learned, I go, you know what? I'm going to let a property manager run this. They're not going to be quite as friendly as me, not as forgiving as me, and at least I'll get my rent collected. So as an investor, figure out how hard you want to work. Do you want to make a higher return and build up that portfolio and save on the property management and deal with those issues? Or do you want to systemize it out, scale it, focus on your career, and let this be a steady investment? There is no wrong way. It's up to you as an investor to choose that path. So that is a basic walkthrough of getting your first rental property and starting your journey to wealth building through real estate. If you're ready to dive deeper into any of these steps or to get your next rental property, remember to like and subscribe BiggerPockets and all their investing knowledge and insights. And if you like this video, leave a comment below. You guys ask as many questions you want. I promise you, I will personally answer them. I want to thank everyone for watching this video on how to get started in real estate. I'm James Dainard from the On the Market podcast. For more information from me, check out our podcast or go to JDaneFlips on Instagram or jamesdainard.com.